Welcome back to the third video of our series, Building and Explaining a CCA Comms Trading Multiple Tool. In this video, we will continue building the main component of our tool, namely the calculation sheet. Please note that we purely focus on the data in this video, or better, the data collection, meaning we do not analyze or question the data at this stage. However, we will dedicate a sole video on the analysis of our tool. So let's get started. First, we collect some basic information of the company, in our case BMW, like country, last fiscal year, last calendar year, last LTM data, and a control field to check whether the fiscal year equals the calendar year. The check is introduced to account for different fiscal year ends or periods. That's also the reason why we've used different time identifiers in the control sheet, as you can see here. Next, we enter or link the respective dates for the automatic data collection from the control sheet, namely share price date, which for the past year is simply the date of the last year's balance sheet data, namely year end, and for the current or LTM data, the current date, or if you remember, the fixed date, we could enter in the control sheet. Furthermore, we have to account for the selection of LTM or calendar year in this column to select either the fiscal year end date, fixed share date, or today's latest sale price. Therefore, the rather complex formula, the respective time period, is automatically adjusted in the headline. The next date is for shares outstanding, and to be honest, is somewhat redundant if CapitalIQ could collect the most recent data on shares outstanding, as it seems the data is only available for workdays and the day before today, so we have to enter this somewhat awkward formula to calculate the last workday. Leave a comment if you have a fix for this issue. Otherwise, we will check and discuss this topic in our analysis video. Next, we simply collect the data for a balance sheet and P&L date for the respective period dates and the identifiers for the period types, which we need for the following data collection. With that, we can proceed and define the company specific data we need to calculate our multiples. The structure for the following data fields always follow the same logic. We have two rows, one for the automatic data collection of your data provider, which is gray, and one manual line in the known coloring. The reason using this structure allows everybody who has no data provider to use this tool and to manually adjust single data points, which might be necessary due to false or missing data, as we will show in our analysis video. At this stage, please note that the CapitalIQ formulas which are used might be outdated, or there are alternative formulas, so please double check if you would like to use the model for your purposes. So finally, we start collecting data to calculate one key input of our multiple valuation. Just a quick reminder, as you're well aware, multiples are nothing else than a fraction, whereas the numerator either represents enterprise value or equity value depending on the denominator, which is often a performance profitability related KPI. We will briefly explain the interplay of numerator and then denominator in the analysis video. For the moment, we focus on the calculation of the enterprise value. Therefore, we start by calculating the market capitalization, which is shares outstanding times share price. As you can see, the gray lines represent the CapitalIQ formulas, which are linked to the company identifier in the top and the respective date time identifier. The product of shares outstanding and share price is the market capitalization or equity value. To account for different types or classes of shares, we will introduce a separate line for preferred shares in a minute. The formula to calculate the market cap is already considering whether you selected CapitalIQ or manual input for the calculation. Next, we calculate net debt, which in our case is simply total debt minus cash and short-term investments. This is basically a simplification. As you are aware, there are a ton of different items which could be considered in net debt or not. In this sense, we rely on the definition of CapitalIQ with respect to total debt and cash, and we'll go into detail in the analysis video regarding this important topic. For the moment, we assume that the net debt calculation is sufficient based on our ingredients. Another typical component of enterprise value are pensions. It might seem trivial, but this item could have significant impact on the calculation of enterprise value depending on the type of pension scheme the company utilizes. In particular, we will discuss defined benefit obligations and defined contribution plans in the analysis video. Next, and as discussed earlier, we add the value of the total preferred shares the company might have issued. Preferred shares are common shares with special rights, typically related to higher dividend payments. In this sense, preferred shares are hybrid securities and bear debt-like features, while we add them to the EV. At this stage, you might ask, and what do we do with in-the-money options? You're right, typically these should also be added to the market capitalization calculation, so feel free to add a line in your model. In our case, we will keep it simple. Last but not least, we add minority interest, which represents the portion of revenue, EBIT or EBITDA, which, even though is accounted or fully consolidated in the respective financials, but not owned 100% by the company. Therefore, we add the value of the subsidiary or investment of the company, which is fully consolidated but not owned 100%, e.g. the minority interest, to our enterprise value as the respective sales, EBIT or EBITDA, is in the consolidated figures. With that, we now have our enterprise value, so one ingredient is ready for our multiple calculation. Next, we simply add the profitability related KPIs. We would like to use in our relative valuation sales, EBITDA, EBIT, and diluted net income. Basically, this is straightforward. Just one point regarding net income, as you will see in a minute. We use diluted net income to compare the net income attributable to the common shareholders. Therefore, any preferred dividend is subtracted from the net income, hence diluted net income. So now we are ready to finally calculate multiples. Don't get blinded by the formulas. It is just enterprise value divided by sales, EBITDA or EBIT And for the price-earnings ratio, it is market capitalization or equity value divided by diluted net income. In the next section, we prepare our output sheets and also introduce a check for the multiple calculation based on two tests. The multiple is bigger than 0 and the multiple is below the multiple cap we defined in our control sheet as shown in the previous video. The enterprise value is also converted to the desired currency, and we also add a check that all relevant currencies for the filling data, e.g. financial statement data, share price, and forecasts or estimates are correct or similar. We will showcase an example with different currencies and show how to handle these cases. The exchange rates, as you know, are entered in the control sheet. The last section introduces some statistics like margins or growth rates, which are useful when comparing multiples of peers and analyze the multiples relative to each other. Furthermore, we will utilize these stats in a simple regression model to give you another valuation technique, which basically is more or less a fancy graphic. So for today, this is it. I hope you enjoyed the video, so please stay tuned for the next part when we build the output sheet. If you are interested in the tool or have any question related to this topic or valuations, please drop a mail to the address in the video description. In addition, if you are interested in other topics or offering, please reach out. We are happy to assist you in training, valuation, or any related advisory. Thank you and bye-bye.